I'm going to start off with you. You've been in this room on one of these decision days. Have you ever seen a time before that you can remember where there's been so many questions about whether it's going to be a 25 basis point cut or a 50 basis point cut?
This is certainly unusual, and it's also unusual that those questions started to emerge all of a sudden on Friday out of some newspaper articles. So I think it's going to be a very good discussion. I don't think it's going to be tense. It will be collegial. It will be very fact-driven, and then we'll all learn at 2 o'clock what the consensus is.
So, Rachel, coming over to you, here on TV, here on CNBC, we kind of look at every economic report. A lot of our market watchers looking at each one, most recently the retail sales report, and we kind of think that's going to give us insight into what the Fed's going to do, and that may change their mind each step of the way. You're talking to these FOMC members and covering them. Is that how they see things, or are there just bigger data points that they follow, and these other ones are more, I guess, minor?
I think the answer is all of the above. Fed officials are constantly talking about this very wide dashboard that they're using to fill in this picture of an economy that has continued to surprise them over and over. What I think has been interesting about the last couple of months is that it feels like there's been quite a bit of weight attached to each incoming data point. First, the August jobs numbers were supposed to tell us one way or the other what size cut we could expect in September. Then that wasn't really all that clarifying. Then we got the August CPI, and it just seems that there's sort of this crawl from one data point to another, thinking that it might offer some sort of final clarity about the Fed's moves. And still, that overall picture is a little bit murky, even though we have an economy that's looking strong. We saw that in the retail sales data this week, and now we're just waiting to see what the Fed officials decide to make of all of it.
So, Roger, coming over to you, how do Fed officials view some of the slowdowns that we've seen, not only in the economy, but some of the, I guess, disruptions that we've seen in the market? Do they look at both of those when it comes to weighing out their decision?
Obviously, as Rachel said, there's a wide dashboard. I think that's a great phrase. You heard Jay Powell say they are data dependent without being data point dependent. So yes, they will be aware of market sentiment. They are certainly aware of what we call financial conditions, the fact that the market has been rallying, lends some forward momentum to the economy. And as Rachel's implied, they'll be looking at the whole range of all the data. It's all against the backdrop of what I think is an economy that's fundamentally very strong. This slowing has been desired because it means the particularly labor market is getting back into balance. So the real question is not whether or not the slowing is desired. The question is for the future, what do they have to do to try to make sure the slowing doesn't get out of hand and to keep it balanced so that they achieve that thing that we call the soft landing. And that's really what the discussion is going to be about today.
So, Rachel, again, you've been talking to the FOMC members. Do they still believe that we're firmly on pace for this soft landing? I mean, are they seeing a situation where that soft landing may be in jeopardy and maybe that 50 basis point cut is very much needed, as we've heard a lot of people mention? Wharton School professor Jeremy Siegel has continued to beat the drum that 50 basis point cut is overdue.
I think the mood is actually quite optimistic. I mean, Fed officials have been so humble and tried to approach this question very steadily, but I would say the mood at Jackson Hole is really quite optimistic this year, that the soft landing is in sight. We're not seeing signs of a recession. The question now is how proactive to be about this job market slowing. And I think it's important to note that kind of slowing is not signaling, mass layoffs or a spiking unemployment rate. It's more about, could that kind of vulnerability, could those cracks, that slowing that we're starting to see, escalate, and how much room is there for the Fed to get out in front of it? Also, it's important to note that inflation has come way down. Rates are coming down because officials have finally secured that level of assurance and confidence that they're getting closer to target. They just want to be able to land this plane in a way that keeps that inflation fight under control and make sure that, the job market doesn't weaken in a way that Chair Powell made very clear they do not want it to.
So, Roger, is there any chance we're just kind of overthinking this, that the Fed's told us they're data dependent. We see the data, so that should lead them to their decision. And then also, we have people like Jeff Gundlach from Double Line Capital that says that generally the Fed funds rate, it just follows the 2-year. I'm looking at the 2-year right now at 3.61. The Fed funds rate at 5.25 to 5.5, and that it just simply has to come down. It's kind of a mechanical thing. Is there any, in your mind, credence to that idea from Jeff Gundlach?
No, I think there's some credence to it, but I think the bigger picture story is they are, as you just heard, trying to land a very complicated and large plane. And also, we're very focused today on what is basically a small distinction between 25 and 50 basis points in the larger picture, which is they are going to be gradually moving rates down. The challenge is they don't know exactly where they're going to end. And so that is actually, the more serious conversation. It's too early to have it, but we should recognize the big theme here is inflation has started to come down. They're gaining confidence. I put a little footnote on that inflation story. The last core CPI reading was still at a handle that started at 3. I think it was 3.2. So we should be careful. The battle against inflation is not won. And yes, the economy is still very strong. The most recent GDP number, GDP now forecast from the Atlanta Fed, I think was at a 3% growth annually. So there's a lot of data to consider, all of which says they should be moving down, but at, I think, a more cautious pace as opposed to it's mechanical, let's just get going.
Roger and Rachel, we're almost out of time. Roger, I'm going to start with you. I want to ask, again, we're kind of debating 25 or 50 basis points for this meeting. What about November? Are we pretty much certainly going to get a cut in November, or is that still in question?
No, I think we're on a path towards reducing rates. Rates are in restrictive territory. We don't know how far they are into restrictive territory, but certainly I would expect a series of cuts the next 3 meetings and probably into next year, as long as the economy performs as currently expected and they maintain confidence that inflation is coming down.
Rachel, same question.
I mean, we'll get a little bit of a sense in the projections that come out at 2 o'clock. It'll give us some sort of guidance for where we might expect rates to settle at the end of the year. But an important thing we haven't touched on yet is November is the election. I don't want to suggest that that will sway the Fed's decision one way or the other, but any sort of announcement that comes out the week of the election will certainly carry a lot of consequence if we already think this meeting is a big one.